students, now we have discussed in the last class option pricing theory, that how to value an option. And today we will be proceeding towards some Greeks. Greeks are a further extension of the same, what we have covered so far. And the first topic is delta hedging. So, I'm sorry, that the Greece is further extension of the same. That when a company, when a party is writing or selling an option, the seller. So how many shares it should hold? For example, the party is selling 80 contracts option. Now, how many shares it should hold? In other words, or sometime in exam, they may ask you that the party has 1.2 million shares. For example, how many contracts it can sell? Right? So in two ways, how many shares it should hold? It wants to sell this. Or it has this share, how many contracts it can sell. So in any way it can be. So delta hedging helps us in deciding that. So basically delta is, the definition is that it is a change in call option value. The ratio of that, if price change, price of underlying, price of share change, so how much is the value of option change? Remember, we discussed derivative. If you remember that, we discussed that derivatives are which value of derivative, how it is right? Due to a change in underlying item. Do you remember that? So similarly, so delta, what is that? That change in, if there is a change in share price or underlying item, so how much is the change in value of call option? So their ratio is called delta. For example, if the value is 1, it means the whatever change happens in the share, the same change happens in the value of option. If this value is 0.75, it means share price change is more and value of option change is less. If it is more than 1.5, it means value of option changes by 1.5 times as compared to the change in value of share. Now, so here is the delta. So in the formula, basically, which we need not to memorize, I told you, formula we need not to memorize, of calculation of value ND1 is called delta. A value of ND1 is called delta, right? So by the way, we need not to calculate ND1. It will be given by the examiner. Now, so So delta hedging allows to determine the value of shares that we must buy, right? If we are option, if we are issuing option. So you see here, what is the number of call option you have to sell in order to, if you have option, that if you are holding this share, ND1 is 0.8. So, and option contracts can be sold for 1,000 unit of 1,000. This formula you need to memorize. Number of contracts which can be sold is equal to number of shares over delta of option into contract size. This is what you need to memorize. Now, by the way, this is now irrelevant. Through the sheet, the formula sheet. Now, so you see here, number of shares, delta of option 0.8, contracts is 1,000. So they can sell 250 contracts. Another example. For example, the company wants to sell 500 option contracts. Delta of option is 0.6 and contract size is 12,500 shares. How many shares it should hold to hedge the above situation, above sale of options? Yes. So just see here. So number of contracts, we know the formula, is equal to number of shares divided by delta of the option into contract size. So number of shares we need to calculate. Number of contracts 500 into delta 0.6 into 12,500. What is the answer here? What is the answer here? 3750000, right? This is the number of shares they should hold. Okay. Now, so the factors affecting the delta value, of course, risk-free rate, volatility, whatever is used in the options, they are affecting delta value. So delta we have learned. What is delta? And what is delta hedging? So we are hedging the sale of option by holding number of shares or vice versa. My question from you. PXP has 65,000 shares. It wants to sell call options with delta value of 0.85 and contract size of 1,500, 1,300 you can do. Okay, shares each. How many contracts it can sell? Be quick and solve and give me answer. Be quick. Give me answer. Great. So you see here, number of contracts, the formula is equal to number of shares. Number of shares divided by 0.85 into 1300. So 59 contracts. Thank you. We have not to forget the formula. That is important. Next, let us proceed further. So delta hedging is done. Any confusion, any question you can ask before I proceed. It is important. And all of a sudden, examiner asked 4 or 5 marks. Yeah. And they say explain actually a bit as well. Means you have to tell the company need to buy this, hold these shares to sell this. Yes. Now, so the point is you need to grasp it. It is quite easy. It's been long, it was tested, but it any time. Gamma. Gamma is now another ratio, although its calculation is not testable. Change in delta value to change in price of underlying. What was the delta? Change in option value to change in underlying. It is change in delta value to change in underlying. It measures the extent to which delta changes when the share price changes. Yes. Higher the gamma value, of course, it is very risky because delta is being affected too much change. It will be difficult for you to maintain a hedge because small share price change will change the delta value a lot. You need to buy or sell shares or contracts. The purpose of delta is that you have to maintain your hedge. You have to keep yourself hedged against the risk. So gamma value will be highest for a share which is Okay. Yes. Small value, then it can change to the positive, change to the negative, right? Now, so theta, change in the options price over time. It is basically time value is decreasing. We said that the option has two values, intrinsic value and time value. Lesser the time, lesser will be the time value. Higher the time till expiry, higher will be the time value. So it is the loss in the value of option over time towards zero. How the value is lost. So theta is usually expressed as amount lost per day. Right? Now, so amount lost per day. So you see here, this summary is also given. Delta of change in option value with the change in underlying assets. Gamma change in the delta value with the change in the value of option over time. So this summary will also help you to memorize this. Very easy now and conceptual as well. Now the next topic is wonderful. One of my favorite topics. That is called Merton Model. The concept behind it is such an interesting concept that is wonderful. Now, the next point is, what is the concept behind it? Come here. For me, as a business owner, what is equity? Now, I will take you to the basic knowledge. If you remember the accounting issue, that assets of the business is equal to equity plus liabilities. The F3, financial accounting. So equity is equal to assets minus liabilities. Now, what does it mean? For example, assets are of 1200 million. Liability is 1000 million. This business still has my interest. God forbid, if assets are of 1200 and liability is 1300. Now minus 100 net. This business will lose my interest. Yes, I will not have any interest in it. As if this is in loss. Negative. So basically, in this case, I still, if pay off all the liabilities, this is business's benefit for me. We say this is option in the money. This is option out of money. No benefit for me. So here I will exercise the option to run the business, to pay off the liabilities. And here I may not. If I will lapse it. The point is, when option is out of the money, option is in the money. So it is just like that. These liabilities are exercise price which I need to pay to have claim over assets of the business. This is the market value of the business. Market value, which I will get. So PA and PE of the Black-Scholes model. If I say, so Merton model, they say, Merton model talks about that. They say you can value equity by using Black-Scholes model. How? They say, come to the notes. Five values we need for Black: market value of assets of the business. Market value of assets of the business minus current liabilities, any. So this is actually market value of assets. Any current liabilities are deducted from it. Volatility of asset is given. Redemption value of debt. What is it? It is, we convert liabilities, mean long-term liabilities these are, into zero coupon bond and calculate equivalent redemption value. Don't you worry. And that redemption value is called exercise price, PE. This time to redemption, it is called duration of zero of that liabilities. Duration. Duration, we have studied it. And I will learn that. We will learn that. It is very interesting, students. It is very interesting. So what I'll be doing, I will take you to the Excel sheet because we need to do that. It there. Just a minute, please. I need to open Excel sheet. Yes. Just read this example first. For example, if this is the only this question. For example, these two requirements are not there. Still, we need to calculate to value the value of equity. These two still must have to be calculated. Yes. Yes. Merton model. Example. What is the step one? I told you. We need 5 elements for Black-Scholes model. 5 items to be put in that. Then we can calculate value of equity. But here in the Excel sheet, I'll be calculating those 5 items. Bob has 100 million par value of debt in issue at 5% coupon with 5 years to maturity. The current cost of debt is 8%. The fair value of total asset as current liability is 90 million, has a monthly volatility of 8%. Risk-free rate is 6%. Okay, right? You can do it. So PA is given, market value. What is that? 90 million. Risk-free rate is given, 6%. Volatility, monthly volatility. That is 8%. We need to calculate, by the way, annual volatility. It is variance. That is equal to 12 into this. And now standard deviation. Standard deviation volatility. This raised to power 0.5. Square root, in other words. If I do this, raised to power 1/2. Just 1 minute, please. Calculation is, there is some issue in calculation. This into 12. Yes, it's square first. It's square into 12. Now, so we calculate its variance into 12. Okay, variance, standard deviation square, annual variance. And then we took its square root to convert it into standard deviation. That's correct now. Right. The next point. The next point is, I repeat, it is volatility, its variance into 12, and then again standard deviation. The next point is, where we are. Yes. So what we need to do? We need to calculate PE. And it is redemption value of equivalent zero coupon bond. Now, what is zero coupon bond? On which no regular interest. Coupon is annual interest. So this is 100 million par value of debt is in issue, 5% and payable like this. So 1, 2, 3, 4, and 5. Yes. So 5% coupon bond. So coupon, what will be that annually? 100 into 5%. And in the final year, redemption at par value and cash flows of the bond. That's better. Now, present value at the rate of, what is the rate? Cost of debt 8%. This into 1.08 raised to power minus this. So present value of bond. Now focus everyone. I want to discuss one thing here. If an investor get this today or these amounts like this, there is no difference. Because he's getting all this amount today, 88 million. This now or like this in the spread, annual coupon and repayment. So future value of the bond or you get the amount into 1.08 raised to power 5. You get this value at the end of one value, year 5. You don't get any amount like this. You get this amount today, present value, or this amount in 5 years time, one amount. It has the same value. Or these amounts like this. Means that if you are not getting any coupon, any payment during the life, rather you get this one amount at the end of your life. This is called redemption value of zero coupon bond. Now, this is redemption value of equivalent zero coupon bond. This is PE 129.33. We got it. Any confusion, any problem? Is it clear so far? Tell me. Is it clear so far? Now, so students, now what we need? We need 5 items. 1, 2, 3, 4. Time till expiry is available, not available. T, not available. And that is calculated duration of this, which is the second requirement as well. Redemption value we have already calculated. So yes, T. T. We need to calculate. So total present value. We have already calculated present value, right? Yes. That is also calculated above. 88. Now, weighted average, that is equal to this divided by 88. 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 Multiply with relevant number of year. This into this. So duration. This is the duration. 4.5. So time till expiry is T. We got it. Now we simply have to put all these figures in the Black-Scholes model and we get the value of equity. Just a minute. Let me open the platform so that we can do it. So I'll open the BSOP calculator and put all the data here, which we calculated over there. PA and PE. Time till expiry is 4.5. Okay. Standard deviation is 0.27. R, what was that? Standard deviation 0.28. R is 6.06. PA 90. PE 129.33, which we calculated recently. So value of call option equity is 17.93 million. How much? 17.93 million. So value of equity through BSOP 17.93. Now the point is, if you see the otherwise, they have 100 million debt and assets are 90 million. Apparently, it doesn't seem something worthwhile. Assets are less. Assets are less. Liabilities are more. So, but Black-Scholes option pricing model used time value of money, volatility of assets, incorporated that and calculated value of BSOP, value of equity through BSOP. Is that clear? Any confusion? Any problem? Is it clear? Tell me. Yes or no? Is it clear? So it is complete now. So I have to do one or two past paper question from the kit with you on Black-Scholes option pricing theory today to wind it up for today. Okay. And just give me 5 minutes break. I'll be back and then join. Just 5 minutes, please. Yes, students. Now I'll be opening the exam kit in front of you and we'll be doing some questions on real options. There is a question. The name is MMC. Here it is 31 as well. And you know, it was tested in September in two past papers, others as well. Okay, 32. No, it is not. MMC. Yes, here it is. 31. A bit old question, but it is good one. Yes. So please read this question, MMC, from here to here, A and B part. Read it well, please. Students, the point is, estimate the financial impact of director decision to delay the production and marketing of game. The Black-Scholes option pricing may be used. Okay, right. BSOP calculator has to be used. Now, MMC is considering whether to undertake the development of a new computer game based on advisory film to be released in 22 months. It is expected that the game will be released available to buy 2 months after the release, means 24 months, 2 years, by which time it will be possible to judge the popularity of film with a higher degree of certainty. However, at present, there is considerable uncertainty about whether the film and therefore the game is likely to be successful. About MMC would pay, although MMC would pay for exclusive rights to develop and sell the game now, the latter are of the opinion that they should delay the decision to produce and market the game until the film has been released and the game is available for sale. Okay, good. They would spend 12 million immediately to spend. So these are the cash flows of the sale of the game for a year. And to pay for the exclusive right to develop and sell the game. Following this, the company will require 35 million for production. Distribution and marketing costs at the start of 4 years. This is the initial investment of the project. Okay, right. It can be assumed that all costs revenue include inflation. Yes, okay, right. The relevant cost of capital is 11% estimate the volatility at standard deviation is 50% now. So, students, the point is they will spend 12 million now. Okay, right. For the development. Okay, I'll open the Excel sheet. Because we need a few things. Delaying the option to delay the project. What if option is not delayed? What if it is launched now? If game is launched now, for example, so cash flows will be investment is 35 billion now and 25, 18, 10 and 5. Now, the present value we need to calculate at the rate of 11%. This into 1.11 raised to power minus this. So NPV. $12.73 million. Initial cost is now, they say, this 12 million development cost is irrelevant. Whether they launch the game or not, because development 12 million cost will have to be spent whether they launch game now or in 2 months. Okay, 2 years. So considering the 12 million cost, so what is the NPV? This minus 12 million. Only this. No option to delay. So T is 2 years. R is risk-free rate is 5%. Standard deviation is 50%. PA, exercise price 35 million. They have to invest it. $35 million. PE, exercise price. They invest. And PA, we need to calculate. We need to calculate the market value because it is delayed now. So PA we need to calculate. 2, 3, sorry, it will start from year 3. So we need to calculate here. So let me calculate here. Year 3, 4, 5, 6. Because now it will start from year 3. Cash flows. These cash flows will start from year 3. Like this. Present value at the rate of 11%. this into 1.11 raised to power minus this. Yes. So present value of cash inflows of the project, 38.75 or 7. This is called PA. Option to delay is called call option. We have all the data now. We can put it into the Black-Scholes model of option pricing. So come here in this formula. So PA, that was, and PE. PE is 35. Time to delay is 2 years. Risk-free rate was 5%. Volatility was 50%, 0.5. And what is the PA? We calculated recently. PA, 38.7. 13.61 is here. Value of call option. So option to delay is, option to delay a project is called call option. So it has a value through BSOP calculator. BSOP calculator. How much? That is 13 point, how much? 61. Million. Yes. So the first part is 8 marks is done. How easy 8 marks are, you can see. Second one, briefly discuss. We need to discuss the answer as well. Yes. Please note down. I will explain. Without delaying the project, it has NPV of 12.74 million. And with the initial development cost, when it is considered, it reduces to 0.74 million. While with the option to delay, the value of project is 13.61 million. And after considering initial 12 million, it is 1.61 million. So, with option to delay, the project's worth is increased. However, it should be considered that there are certain assumptions involved in the calculation of option to delay. Such as volatility and interest rate will remain constant. And this 1.65 million, 61 million is an indicative value. It is an indicative value and may not be the exact value to be received. However, the next paragraph, however, option to delay the project is not the only option with the company. It's not the only option. Rather, they can develop the gaming platform and even sell that as well. Or even sell that as well. Or they can exploit some follow-on projects based on this initial project. Done. That's the end of it. Students,